In this video, we'll cover some real-world examples as to how to calculate one's RMDs, ultimately to help you avoid paying the IRS a 25% tax penalty on missed distributions. If you don't know who I am, my name is Chris Dime. I'm a financial planner out of Edmonds, Washington, and I specialize in working with folks to and through retirement. A super common planning topic for our clients and our clients' parents are going to be required minimum distributions. These are the mandatory withdrawals that the IRS forces one to make from their pre-tax retirement accounts. In my previous video, we covered at a high level how required minimum distributions work, who they apply to, when they apply, and ultimately what you need to do to stay in the IRS's good graces. But in today's video, we'll cover some real-world examples so you can see how they directly apply to you once you start entering into RMD territory. So let's jump in. If you didn't have a chance to watch my last video, I'll link it above here, but it's going to be helpful to set some context as we enter into some of these examples. Now, if you don't watch it, no big deal. You can still follow along and get some good nuggets out of this. But of course, the more information and the more context, the better. For a quick recap, however, required minimum distributions, or RMDs for short, are the mandatory amounts of money one must take from their pre-tax retirement accounts once they age into RMD territory. And that age is going to be somewhere in your 70s. Now, there are, of course, other times when RMDs would apply, and a lot of times these would be for inherited retirement accounts, but that's beyond the scope of today's video. We're just going to focus on required minimum distributions from your own retirement accounts. And to keep it simple, without all the background, RMDs only apply nowadays to pre-tax retirement accounts if it's your own RMDs we're talking about. Roth accounts do not have RMDs unless it's an inherited Roth retirement account. Okay, so for a quick recap as to when RMDs start, well, to keep it simple, it's going to be between either 70.5 or 75, depending on when you were born. There's been a ton of changes over the past few years, but as of 2025, these are the rules. If you were born before July 1949, then your RMDs were supposed to have started when you turned 78.5. If you were born between July 1949 and 1950, then your RMD start date was when you turned 72. For those of you born between 1951 and 1959, your RMD start date is when you are going to be 73. So for some of you, that's already started, but for many of you, that hasn't started yet. And for those of you born in 1960 or later, your RMD start date will be when you turn 75. And as it pertains to calculating your age, the IRS basically says, what age are you going to be on December 31st of a given calendar year? So let's say you've aged into required minimum distribution territory, aka RMDs now apply to you. Well, based on your age, your marital status, and the age of your spouse, if you have one, that's going to dictate how much longer the IRS thinks you're going to live for, which in PC government terms is called your RMD factor. You need to know your RMD factor because you're going to divide your December 31st account balance by your RMD factor for this calendar year to determine how much you need to take out by December 31st of this year. To figure out your RMD factor, you're either going to use Table 2 or Table 3, and I'll link those down below. These are essentially lifetime tables, aka life expectancy tables, that the IRS pushes out every year, and they make changes as time progresses. Technically, there are 3 IRS lifetime tables, but we're not going to use one of them because one of them only is used by those who have inherited a retirement account. So of the 2 lifetime tables you could potentially use, Table 2 is going to be your joint life and last survivor life expectancy table, and Table 3 is going to be the uniform lifetime table. If you're single, you're only going to use Table 3, and if you are married, you might use Table 2 or Table 3. Table 2 will come in handy if your pre-tax retirement account's sole beneficiary is your spouse, and your spouse is more than 10 years younger than you. So by definition, that means if that doesn't apply to you, you're going to use Table 3. But for a better definition, Table 3 is used by single IRA owners, aka those without a spouse, and it's used by those who do have spouses, but either their spouse is not their sole beneficiary or their spouse is not more than 10 years younger than them. And for quick clarification, the IRS looks at your marital status based on January 1 for the calendar year in question. So unfortunately, if you had a spouse pass away throughout the calendar year, the IRS will still consider you married for the purposes of determining which lifetime table you fall into. Beneficiary status, on the other hand, is dictated based on how things were set up on December 31st of the calendar year in question. So if you change beneficiaries throughout the year, that could have an impact on which table you fall into. Now, marrying those two clauses together, if unfortunately you had a spouse pass away during the calendar year, and ipso facto you then changed who your beneficiary was, the IRS would still consider that deceased spouse to be the sole beneficiary, and they would consider you married for the purposes of dictating which table you fall into. So once again, the calculation we're trying to figure out is what is your RMD factor, aka how much longer does the IRS think you're going to live for. You divide last year's December 31st account balance by that RMD factor, and that gets you your required minimum distribution for this calendar year. And you have until December 31st of this calendar year to distribute all of that money. The IRS doesn't care if you take it all out on January 1, if you wait until December 31st, if you take it out monthly, or you take it out in a random ad hoc fashion. They just want to see that at least that much money gets taken out. And for those of you that are a little bit more advanced financially, you cannot Roth convert this RMD out of the equation. Once the calendar year has eclipsed and an RMD theoretically could be calculated, you must distribute that money from the account. Let's cover a couple of real-world examples to figure out how to calculate your RMD factor and ultimately your RMD. In all these scenarios, let's assume a December 31st account balance of 500 grand inside of a traditional IRA. Let's take a single taxpayer who is going to be turning 80 in 2025, the year in which this video is being filmed. Well, if they're going to be turning 80 and you pull up table 3, which is the uniform lifetime table, you'll find that the RMD factor is 20.2. So if we assume an account balance of 500 grand at the end of last year and an RMD factor of 20.2, then this person's required minimum distribution for the tax year of 2025 is going to be about $24,752. That much money must come out of the account before December 31st of this calendar year. Now let's talk about some married couples. Let's say the older of the two spouses will be turning 74 in 2025. Since this person is turning 74 in 2025, that means they were born in 1951. That also means RMDs started for them when they turned 73, aka RMDs started last year in 2024. Now, if you know a little bit about RMDs, you do know that you can delay your first RMD until April 1 of the following calendar year, aka April 1 of 2025. But whether they did or did not do that, the RMD calculation is the exact same for 2025's RMD. Now, whether they choose to delay or not delay 2024's RMD, that's on them. The 2025 RMD calculation, however, is the exact same. Ending balance last year divided by your RMD factor. For this example, let's assume that their spouse is turning 70 this year. So the spouse is 4 years younger than them, aka not more than 10 years younger than the IRA owner. And we'll assume that the spouse is the sole beneficiary of this IRA. And if that's the case, then we're going to use those qualifications to figure out whether we're on table 2 or table 3. Turns out we are on table 3 again, the uniform lifetime table. And so using our walkthrough in the last example, we're going to scroll down until we see age 74. And that's going to give us an RMD factor of 25.4. And we're going to take that RMD factor and divide it by 500 grand and ultimately get us an RMD for 2025 of $19,607. So at least that much money needs to be taken out of this IRA before the end of the calendar year. Now you might notice as you look at table 3 that the life expectancy doesn't perfectly follow -1 every single year as the ages increase +1 every year. And that has to do with some unique actuarial longevity math. And without getting too deep into the nuance, ultimately what I want you to take away is it's not a safe bet simply to take whatever last year's RMD factor was and just -1 for this year. Because every year the number actually changes as to what the RMD factor could be. In addition, the IRS is known to make updates to lifetime tables as longevity changes for various age demographics. So as much as we would love for this to just be an automatic every year as I get older, my RMD factor reduces by 1, and that's not actually the case. Let's hop to a third example where we look at that same married couple, we look at the same account balance as last year of 500 grand, but let's say in this example, the IRA owner is 74 or turning 74 in 2025, but they're married to someone who is 60 years old. So in this example, a 14-year age gap. For this example, let's assume the spouse is still the IRA's sole beneficiary, but since the spouse is more than 10 years younger than the IRA owner, we're not going to use Table 3, we're going to use Table 2, which is the joint and last survivor life expectancy tables. Now, these tables are a little bit more complicated and there's a lot more of them, but ultimately what you want to do is scroll down until you see the IRA owner's age and then cross-reference the top to find the age of the spouse of that IRA owner. In this example, if you scroll down to 74 and then scroll across the top until you see age 60, you'll find an RMD factor of 28.4. So you take that same $500,000 balance at the end of last year, you divide it by 28.4, and you get a total RMD for the year of $17,605. Now, if you're a bit of a math whiz or you pay attention to detail, you might have seen that the life expectancy for the same age 74 IRA owner, the life expectancy is higher in the third example where they have a much younger spouse. I guess we could surmise that the IRS thinks if you have a much younger spouse than yourself, that you're going to live much longer. Now, I'll let the comments prognosticate on why this might be the case, that an IRA owner is expected to live longer if they have a spouse much younger than themselves. In reality, though, it might simply just be that the IRS recognizes that if this IRA owner passes and their spouse is much younger than them, odds are this retirement account might be the beneficiary's sole income resource for their own retirement. And if that's the case, they might get a little bit of an RMD discount because this money has to last much longer than if, say, both spouses were the same age. Or maybe it's as simple as having a much younger spouse keeps you younger for longer, and all the folks that said age is just a number were totally wrong. In the next video, we'll talk about some helpful proactive strategies to help you get ahead of the game so that you're not planning in an RMD reactive fashion. Of course, if you do nothing and you're simply taking out the minimum distributions every year, if you're in your mid-80s, there might not be a ton you can do proactively. There are a couple of things, and we'll touch on those in the follow-on video. But if you're much younger than RMD territory, then it's definitely going to pay dividends to be aware of some strategies ahead of time to mitigate the impact of required minimum distributions. The reason these can be such a problem is, number one, if you don't need all the money, then by definition you're paying more in income taxes than you otherwise would choose to. In addition, since Social Security is based on your adjusted gross income numbers, your increased income from your RMD is definitely going to cause more of your Social Security to be considered income for the purposes of taxing that income. In addition, and I'll link above here to explain our video on IRMA, you could absolutely fall into IRMA territory and end up paying far more for Medicare Part B and D if you're not careful as to how these RMDs are going to impact your life. So from a calls to action standpoint, if you didn't know you were in RMD territory, well, I suppose now you know, and you should work with your tax professional on how to mitigate the IRS coming to knock on your door and charge you penalty taxes for all those missed RMDs. If you are aging into RMD territory very soon, it's going to make sense to be aware of how RMDs are calculated, which table you'll use so that you don't run afoul of IRS guidance. Remember, just because you're married doesn't dictate which table you're on. You have to figure out the age of your spouse and or if the spouse is the sole beneficiary of your IRA. And then lastly, if you're well away from RMD territory, odds are your parents or loved ones in that generation are going to be entering into RMD territory. And a lot of folks aren't aware of how all these rules apply, so it could be very helpful to make them aware. Either way though, hopefully this was helpful in breaking down a couple of examples as to how RMDs apply in the real world. If you have further questions, drop them in the comments below or get in touch on the website. We'll help you get squared away. Have an awesome rest of your day and we'll talk to you later. Bye.